Welcome back to the Economic Analysis channel here. In this video, I'm going to go over and revisit the debt default model that I have created to predict economic recessions ever since we've come off the gold standard. So the thinking here is that once debt reaches a current level against GDP and factoring in the cost of interest rates, it becomes too much for the economy to handle, and essentially we start going into defaults on debt, and that results in a recession as we calculate our economic growth as GDP by how much we spend and consume. When there are defaults on debt for businesses as well as for personal debts, then it results in a drop in consumption. It results in a drop in spending, and the economy actually contracts by those GDP measurements here. So real quick, let me just go over here. The blue line that I'm showing you here on this chart from Fred over time is the actual default rates on loans pushed out into the economy, as well as delinquency rates on loans. So delinquencies are anything that is non-performing, or there have not been any debt payments made on for 90 days or more. Okay, so you can clearly see the trend here that whenever we see a spike in those defaults and delinquencies on loans, shortly after that, within about 6 months to a year, the economy goes into recession, which is typified by this shaded area here on the chart. So we went into a recession in 1991 after defaults and delinquencies increased by 58% in the last year. And we see the same kind of issue happening here when defaults and delinquencies started to increase about 30% in 2000. From a year ago, we went to a recession, and once again, most famously with 2008, when, we saw defaults and delinquencies really start to skyrocket and peak over that 40% threshold there. And then just real quick, we saw this a spike in defaults and delinquencies after the recession began in 2020, because that was really an engineered recession from forced shutdowns. But again, you can see the correlation there between a rise in defaults and delinquencies on loans and a diminishment in economic growth. So the threshold that I think is really to note here is that once we reach, say, about past the 30% mark, give or take, that really seems to signal that there will be an economic recession happening, unless if there is a sharp reversal in policy by the Federal Reserve and the federal government. So back in early quarter one of 1987, Alan Greenspan, who was chairman of the Fed, did lower the Fed funds rate. And actually, I'll bring that up just to illustrate right quick. But when he did, it sort of saved the economy at that time from a recession. But once he started to raise rates again, raising that cost of borrowing, then that resulted in the recession in the early 1990s. So, yep, you can see here when in quarter one of 1987 here, he started, there were a few spikes in that federal funds rate. Let me pull out the average right quick. So here we go. So in 1987, in quarter one, the federal funds rate had bottomed out right here, but we were seeing that spike in delinquencies on loans from that higher federal funds rate in the previous 2 years. So that was a way of trying to juice that economy, and it was sort of semi-successful there. Okay. Now, the red line here is a model that I created to predict the rise in defaults and delinquencies on loans. So the red line is the total debt in the economy pushed against the real GDP and multiplied by what is called the bank prime loan rate. That's the interest rate that banks charge for their best customers. And that bank prime loan rate is tied to the federal funds rate. In history's times past, it has been the federal funds rate plus 2%. Now it is the federal funds rate plus 3%. So the federal funds rate right now is about 0.25%. It trades between 0 and 0.25%. The bank prime loan rate is 3.25%. So I use that as a base rate to determine the cost of debt in our economy. This is not a perfect model. This should not be taken as a gospel law by any means. But for the last 5 recessions, it has certainly been very predictive here, as you can see by the rise in these in this model's chart here, which is typified and signaled on the right-hand axis. I usually use a threshold of 7. Once we reach that 7 multiplier threshold, that signals that we will go into an economic recession. And that's certainly been the case for the past 4 to 5 recessions. It's been very predictive on that manner. So, all that being said, with the Federal Reserve recently beginning to engage in less expansionary monetary policy and eventually a increase in the federal funds rate, this will raise that bank prime loan rate. And now the question becomes, well, how much can our economy handle before it causes some type of disturbance in our economy and a breakdown in economic growth? Essentially, how high can we raise this federal funds rate and raise the cost of borrowing without it impacting businesses and consumers' wallets enough to where they start to default and become delinquent on loans? So I've sort of projected out based off of total loans and real GDP growth, as well as the Federal Reserve's plot line of what I think they're going to engage in raising the federal funds rate, and have been able to sort of project out when we're going to reach that critical red line of that 7-point multiplier. And it looks like we're going to hit it at the end of 2022, assuming that the Federal Reserve raises the Fed funds rate to 1.25%. Now, the thinking here is that according to the Fed's recent projection dot plot, is that by the end of 2022, the federal funds rate will be trading between 0.75 and 1%. But I'm going to go into a little bit of a worst case scenario here. I'm going to assume that the Federal Reserve is not going to do 2 to 3 hikes in 2021. Instead, what I think is that they're going to do a 1/4 point hike per quarter in 2021. So first quarter, by the end of March, they're going to hike the interest rates to 3.5% to 0.5% on the Fed funds, 3.5 on the bank prime loan rate. And then it's going to be a 1/4 point hike each time. So whereas the projections is that, this should really be, the bank prime loan rate should really be trading between 3.75 and 4, I think that the Fed is going to have to tap on the brakes a little bit faster as we start seeing inflation peak even higher, and they'll push it up. So by the end of 2022, we'll reach that critical threshold where it's like, okay, at these levels, at this cost of borrowing, the economy cannot handle anymore. It's going to start falling apart. Now, does this mean we're going to go into a recession in late 2022 or 2023? Well, no, because this model is predictive in nature. Now, this model is predictive of about, say, a year to 2 years out from an economic recession. So if we start seeing a problem where there's too much or too costly of debt based off the amount of debt in the economy by the end of 2022, then more than likely we're not going to see a recession before 2024. My guess is that we'll probably see it sometime in early 2025, late 2024. It would be ironic if it happened in late 2024, because that would put it right at the time of the re-election for president, and it would certainly be a doldrums for the Democrats who own that presidency now. President Biden would definitely take the blame for that crash in the economy, regardless of whether it's truly his fault or not. In truth, this is a result of monetary policy. It has been the generous low interest rates that has made it very fruitful to borrow money for businesses to accumulate debt and to save less, which has just set us up for this disaster, because sooner or later it results in price inflation. The cost of debt has to be raised through higher interest rates to counter that, and when it does, it becomes too much for the economy to handle. The economy gets overloaded with debt at that interest rate level, and now it has to correct and go into a recession to liquidate those bad debts. Okay, and this kind of makes sense that the 1.25% threshold is probably going to be the breaking point, because for the last 40 years, the ceiling for the federal funds rate, before it results in an economic recession has been dropping over time. So back in 1981, the federal funds rate reached a peak of 19% before the economic recession of 1981, 1982. But look here, back in 1989, the federal funds rate only raised up to, say, 9.85% before there was a recession in 1990 and 1991. And here, in 2000, the federal funds rate only lifted to 6.55% or 6.54% before there was a recession in 2001. And then in 2006, the federal funds rate could only lift up to 5.25% before once again we entered a recession in late 2007, early 2008. And just to take note here, back in 2018, 2019, when Jerome Powell lifted the federal funds rate to 2.4%, that was enough to cause a liquidity crisis in quarter 3, quarter 4 of 2019. And it resulted in the Federal Reserve to drastically drop interest rates once again to try to prop up the economy and set up a standing repo facility to try to put loans back into those repo markets where there was a shortage of funds. At that time, there was a spike that was going on in overnight lending rates. And had that continued, it would have forced up that federal funds rate even higher and would have resulted in a rise in delinquencies and defaults on loans. And just as proof in the pudding here, back in quarter 4, 2018, we were starting to begin to see that increase in the defaults and delinquencies on loans, signaling that the Federal Reserve had raised interest rates too high. And certainly that popped off on my model here back in quarter 3, 2018. My model signaled that, yeah, we're a little bit too high on those interest rates here. We can't handle that. And sure enough, that resulted in the bottoming out of delinquencies, defaults on loans. They started to creep up. And then the Federal Reserve decided to lower interest rates, which stabilized that delinquency default rates on loans until we had the pandemic and government forced shutdown. So, this has been very predictive so far in our current economy system. And it's something to keep watch over, certainly from what it looks like with the current level of defaults and delinquencies on loans is that they are extremely low right now. So they're very low. They keep dropping each quarter, which is certainly a good sign that the economy is on a technical basis stable, but it is stable because it has been generously supported by high amounts of government spending and welfare payments out to families and individuals. Without that support from the government, it's unlikely that these debt default rates would be so low. So while it keeps the economy stable on that end, unfortunately it has resulted in higher price inflation for everybody, which hurts everybody, especially those on fixed incomes the most. So it's stuck between a rock and a hard place as Odysseus navels between Scylla and Charybdis. I hate to say it, but we're probably going to end up just like what Odysseus' fleet ended up with, and that was a complete shipwreck with Odysseus being the only survivor. In other words, we're probably going to have a total crash in the economy. The Fed's always going to raise rates too high because they never realize that they lower rates too low during the boom times of the economy. And guys, that's what I have for this video right there. Comment on this. Let me know what you think about all of this. If you think that the model is missing something, let me know. I'm always always appreciating any type of constructive criticism, but hopefully this gives you sort of a bird's eye view about where we stand in our economic situation right now. If you like the video, if you like the channel, if you like the content that I provide, make sure you just click that like button and it shows me some support. Comments are always appreciated. Subscribe to the channel so that way you're automatically kept up to date with all my latest vids and information that I pump out. And click that notification bell. If you click that notification bell, you'll always get a ding on your computer or your phone whenever I do upload a new video right away. So that way you can be the first to get and digest this information. To the best of my knowledge, with this debt default model, this one's completely unique to me. I don't know if anybody else who has created this. This is not to puff myself up, but it's to give you that kind of unique information and insight into the way our economy is functioning and what's going to happen in the future that you just might not get on any other channel, or at least broken down and quantified this way. So once again, guys, I thank you for watching this video. I'll talk to you next time.